I'm Tom Conroy and welcome back to the channel. Today we're going to talk about how you can calculate your income tax. Before we get into it, I'm going to give you a bit of an overview on the different tax rates and the types of income liable to income tax. There are three types. You've got non-savings income, savings income and dividend income. Savings income is the savings interest you earn from depositing cash in a savings bank account. Dividends are from owning shares. Non-savings income is generally everything else. So your salary from the job you work, any trading income, property income, etc. The order in which they are taxed is that non-savings income is taxed first, then savings income, and dividend income is taxed last. Non-savings income is taxed at the following rates. The first £50,000, before taking into account the personal allowance, will be taxed at the basic rate, which is 20%. The next £100,000 will be taxed at the higher rate, 40%, and anything above £150,000 will be taxed at 45%. The standard personal allowance for people in the UK is £12,500. However, your personal allowance decreases by £1 for every £2 of income you earn over £100,000. Therefore, if your income is greater than £125,000, you will not have a personal allowance. Savings income is taxed at the same rate as non-savings income and taxed after it. Depending on the tax bracket you're in, you may also have personal savings allowance. If you're in the basic rate tax band, your personal savings allowance will be £1,000. If you're in the higher rate band, your savings allowance is £500. If you earn over £150,000 and are in the additional rate band, you will not have a savings allowance. The savings allowance usually leads an individual not having to pay income tax on the savings income they earn. Dividends are taxed last and at the following rates. If you're a basic rate taxpayer, your dividends will be taxed at 7.5%. A higher rate taxpayer, 32.5%. If you're an additional rate taxpayer, your dividends will be taxed. Something to note is that all individuals in the UK have a dividend allowance of £2,000. That's regardless of your overall income and the tax bracket you're in. Okay guys, hopefully that's given you a good background understanding of income tax. I think we're now ready for me to go over to my computer and work through an example. Just so you know, this is a fairly basic example. It doesn't take into account any gift relief, taxable benefits, or child benefit tax charges. It also doesn't take into account national insurance contributions. Everyone's tax position is unique. If your tax position is particularly complex, I would recommend you go to an accountant to have your income tax calculated for you. So we're going to use Chloe as an example. Chloe is a pharmacist in Leicester who earns £33,000. She also earns approximately £6,000 from selling ebooks on Amazon. She receives £12,000 in property income from a property she owns in Bristol, £110 in savings interest, and £2,500 in dividends. Okay, so we've got all her income sources here. Top left hand corner of the screen. Salary from being a pharmacist, trading income from selling ebooks on Amazon, rental income from a property she owns in Bristol, savings interest from cash in a savings bank account, and dividends from owning shares. Salary, trading income, and rental income are all classified as non-savings income. So we'll put those under the non-savings income column. Savings interest is obviously savings income, and dividends are obviously dividend income. That gives her a total net income of £53,610. That makes her a high rate taxpayer, and therefore she will have a personal savings allowance of £500. Okay, so non-savings income is taxed first. As her overall income is less than £100,000, she still has full use of her personal savings allowance of £12,500. So the first £12,500 will not be taxable. The next £37,500 will be taxed at the basic tax rate, which is 20%. And the final £1,000 of her non-savings income will be taxed at the higher rate, which is 40%. Okay, so £37,500
multiplied by 20%, £1,000 multiplied by 40%. She has savings income of £110. However, as mentioned before, being a higher rate taxpayer, she has a personal savings allowance of £500. Therefore, she will not pay income tax on her savings income. Dividends are taxed last. All individuals have a tax-free dividend allowance of £2,000, so it will only be the remaining £500 which are taxable. As we're around the higher tax rate band, these dividends will be taxed at the dividend higher tax rate, which is 32.5%. Okay, £500 multiplied by 32.5%. That gives her a total income tax liability of £8,063. However, as her employer has already deducted tax from her salary via the payee system, the tax she actually owes to HMRC is £3,963.
The deadline for submitting your tax to HMRC is the 31st of January, following the tax year in which the income is earned. Chloe's income was earned in the 2020-2021 tax year, and therefore she will be required to submit her tax to HMRC by the 31st of January 2022. Okay, so there you have it, guys. I hope you enjoyed today's video. I hope you gained some value from it. If you did, please give it a big thumbs up. If you'd like to see more videos like this in the future, also hit that subscribe button. Until next time.